Let's have a look at the national market. Welcome to episode 8 of Inside the Deal Through Michael's Eyes. It's a fresh take on real estate and business in general. My name is Michael Renick, and I am your host for this podcast. After a 31-year career, I retired from General Motors at the young age of 52, and I moved right into building my real estate career. I currently hold a Florida real estate broker's license, and I focus on serving Florida's West Coast. This podcast combines both my GM and business real estate experience and goes beyond the surface, offering a candid look at how business should be done right. Whether you're navigating the complexities of real estate or tackling broader business issues, education is one of our main goals, and that's the purpose for doing the podcast. So let's take a look, and we'll jump right into this. This is the December monthly market report. Just stepping aside for a second, can you believe we made it to the end of 2024? This is mid-January when I'm recording the podcast. What a year it's been. Let's take a look at some of the factors that we're leaving 2024 with as we begin to enter 2025. So let's look ahead and see what we face in the rest of December and also what we face in 2025. So by looking at today, there are four things I'd like to talk about. What's the current debt level, consumer equity levels, mortgage delinquency, and foreclosure activity. I think those are four very important key points as we look into what may happen in 2025. When we look at consumer debt, it's everywhere. The national debt is higher than it's ever been. Consumer debt is at record levels, and naturally people are beginning to wonder, how is this going to impact the housing market? Is there a crash? Is this the same thing that happened in 2008? Well, those are all fair questions. We touched on this last month, but it's worth revisiting. Right now, consumer debt in the U.S. sits at an eye-popping $18 trillion, not billion, but trillion. This includes everything from credit cards to auto loans, student loans, and yes, of course, mortgage debt. Here's a key point, though. Out of that $18 trillion in consumer debt, mortgage debt accounts for the biggest share, about $13 trillion. I get it. That's a very big number, and it might feel unsettling at first. But here's the difference. Well, there's $13 trillion in mortgage debt. There's also $35 trillion in home equity. That's a huge buffer that we haven't had before. It's this massive equity cushion that keeps the real estate market strong and a key reason why we're not seeing a flood of foreclosures. I'll explain more in just a little bit. Looking at the next slide, it's like I said, true, consumer debt's at an all-time high. The housing market remains strong. The basic reason is homeowners today have a record level of equity. According to ICE Mortgage Monitor, the average homeowner has $319,000 in equity. Of that, they could access a little bit over $200,000 and still maintain a 20% equity position. That's the kind of strength that we haven't seen before when we look at the national scene. Let's talk about delinquency and foreclosures. Thanks to the strong equity position I just shared, foreclosure rates remain historically low. According to the New York Fed, just under 1% of all mortgages are 90-plus days delinquent as of Q3 2024. For context, during the housing crisis, that number was much, much higher. I recently spoke with a major mortgage servicer who told me that as long as defaults stay under 1%, it's considered a very healthy market, and according to them, we have nothing to worry about. Let's take a look at foreclosures. There's good news. Even if a homeowner falls behind on their mortgage, they have options. They can list their home, they can pay off their debt, and in most cases, walk away with cash in their pocket because of the equity positions. According to Adam data, foreclosure filings in October of 24 were up 4% from the previous month, but still down 11% year over year. So you might see headlines about foreclosures ticking up. The reality is that overall foreclosure activity as we leave 2024 remains relatively low. Let's take a look at 2025. What's going to happen? Let's talk about mortgage rates, prices, and sales. What are the experts saying at this point that we're going to see as we go forward? When we look at mortgage rates, the big players, Fannie Mae, MBA, Wells Fargo, are all predicting rates will settle somewhere around 6.33% by the end of 2025. I think we might do a little bit better than that. In fact, some of the experts are suggesting we could actually dip into the high fives. If that happens, that will be a game changer for buyers. Lower rates mean more buyers re-enter the market, and that's good for everyone, buyers and sellers. This is something to keep an eye on as we move forward through the first half of 2025. If the rate hits the fives, expect a wave of buyers to jump back in. In the local video I shared with my mortgage partner, and we talked about they've been predicting rates are going to come down. Well, sooner or later, they're going to have to. But when we take a look at this thing, there's a lot of data out there right now that says we're primed to see a reduction. Let's talk about price. Price appreciation is expected to be steady and healthy, about 3% on average across the country. Again, this is normal. It's sustainable growth. Keep in mind, though, there will always be a few outliers, markets that perform better or worse than the national average. That's why I also do the local podcast once a month for looking at this part of Florida. Some areas might see price dips, while others will remain hot. But overall, 3% price appreciation is exactly what we want in a healthy real estate market. It's a sign of stability. It's a sign that will also benefit buyers, sellers, and the overall industry as a whole. Home sales, what are they saying right now? Forecasts, folks are saying that the new projected new homes existing sales going into next year will be about 5.1 million units. Now, let me back up for a second. This is new homes and existing homes at 5.1 million. Normally, when you hear home sales, they talk about existing homes. We've added new construction to this. The peak of the market was 2021 right here. And when we sort of come back down to the last couple of years, we'll come back up. I think we'll look at 2024 as being the valley of home sales when we look at the overall picture. As I mentioned before the election, there's still a lot of uncertainty in here, but the experts are kind of settling down that we're going to see sustainable price increases. We're going to see mortgage rates falling in the right area, and we're going to see an increase in home sales as we move into 2025. Just before I close, I want to share this. Things will change. We're going to stay on top of this. This is why I watch the data. In order to be a great real estate broker on Florida's West Coast, I need to understand the national scene and how it may impact the local scene. And then I also, as importantly, need to understand how the local numbers are different. That's why we do these. We study these things daily. In closing, though, I would like to wish everyone a great and safe holiday season. We'll be back in full force in 2025. If there's anything I can do to help, my direct cell, because I want all my clients to have access to me when it's convenient for them, not the other way around. That number is 941-400-8735. I look forward to talking with you. Take care, everyone.